coming. We are getting off to a slightly late start. We're still waiting on our company secretary, who to these proceedings is indispensable. I mean, I could carry on without her, but our company secretary is kind of crucial to the proceedings. So she's a couple minutes away, so we're going to just give her a couple more minutes before we get started. So apologize for the late start, but we'll get started in a couple of minutes, okay? Okay, good morning again, everybody. My name is Gary Sinclair, Chairman of Kingston Properties. Welcome to our 13th annual general meeting. I'm calling the meeting to order officially. We're going to begin, as we usually do during these proceedings, with a prayer that is going to be conducted by our secretary, Madame Nicole Fogel.
Since we're both vaccinated, let us pray. Holy and gracious Father, we thank you for this day. We thank you for this company. We thank you for our shareholders, for the management and staff of this organization. We pray, Lord, that you will bless this meeting. In Jesus' name we pray. Amen.
Amen. Don't go too far, Madam Secretary, because we're about to read now the notice of the annual general meeting, which is your absolutely critical role as well.
Okay. Good morning, everyone. Notice is hereby given that the 13th annual general meeting of Kingston Properties Limited will be held at Leeward Suite, Knutsford Court Hotel and Suites, 16 Chelsea Avenue, Kingston 5, in the parish of St. Andrew, in Jamaica, on 14 July 2021 at 10 a.m. for the following purposes. 1. To receive the audited accounts for the year ended December 31st, 2020, and the reports of the directors and auditors. The company is asked to consider, and if thought fit, pass the following resolutions. Resolution 1, that the audited accounts for the year ended December 31, 2020, along with the reports of directors and auditors circulated with this notice convening the meeting, be and are hereby adopted. 2, to declare final dividend. The company is asked to consider, and if thought fit, pass the following resolution. Resolution 2, that the interim dividend of US a lot of zeros, 0.0059 per share, paid on August 10, 2020, be and is hereby declared as final for the year ended December 31, 2020. 3, to elect directors. The directors retiring by rotation in accordance with Article 107 of the company's Article of Incorporation are Mr. Garfield Sinclair and Mr. Gladstone Luars, who, being eligible for re-election, offer themselves for re-election. The company is asked to consider, and if thought fit, pass the following resolutions. Resolution 3, that Garfield Sinclair, retiring by rotation, be and is hereby re-elected. Resolution 4, that Gladstone Luars, retiring by rotation, be and is hereby re-elected. The next sub-resolution B, Mr. Philip Silvera was appointed a director of the company on January 1, 2021, in accordance with Article 105 of the company's Articles of Incorporation. His appointment expires on the date of this AGM, and being eligible offers himself for election. The company is asked to consider, and if thought fit, pass the following resolution, which is Resolution 5, that Philip Silvera, retiring pursuant to Article 105 of the company's Articles of Incorporation, be and is hereby elected. C, on the recommendation of the Board of Directors, Mr. Resworth Burchison, who is eligible, offers himself for election as a director. The company is asked to consider, and if thought fit, pass the following resolution, which is Resolution 6, that Resworth Burchison be and is hereby elected. 4, to appoint the auditors and fix their remuneration. The company is asked to consider, and if thought fit, pass the following resolution, which is Resolution 7, that KPMG, having signified their willingness to continue in office as auditors, the directors be and are hereby authorized to agree to their remuneration in respect of the period ending with the next AGM. And finally, to transact any other ordinary business of the company by order of the Board of Directors. Nicole Fogel, Company Secretary, June 14, 2021. Thank you.
Thank you, Madam Secretary. So I want to introduce who is here today. We have from our board of directors, we have Mr. Peter Reed, Mr. Philip Silvera, we have Lisa Gomes, and you've obviously met already Madam Secretary, Nicole Fogel. We have our CEO here as well, Kevin Richards. And online we have Gladstone Tony Lewis on our stream, and our head of audit committee is probably there as well, John Mitchie Bell. So we are moving now to introducing our auditors, who are KPMG, our registrars, JCSD, and other outsourced partners and key stakeholders. So we're moving right into the chairman's remarks. Again, I feel like this is a bit worn. We are all aware of what 2020 wrought with the COVID-19 pandemic. It was a defining moment. It was a seminal moment. It was all kind of various moments. What it clearly did, though, was force businesses of all kinds, including ours, to rethink and adjust their various strategic goals and strategic imperatives. We were obviously no different. Our first concern was the safety of our employees and all of our various stakeholders, which we went to great lengths to ensure we could secure. And secondly, as a business, we moved, we believe, expeditiously to ensure that we were going to be as resilient as we possibly could, but not just be resilient, be able to bounce back as fast as possible once, as we expected, we had turned the corner on the pandemic. So in order to do that, we focused on a couple of things. By ensuring we were as liquid as possible, boosting our cash resources, and fortuitously, we had just come off of an APO, an additional public offer, and we're sitting on a bunch of that liquidity, and our intention was to maintain it in order to sustain us through what we thought was going to be a fairly trying period. We also, though, thought that it would be a good idea to use some of that cash while we had the lull in business and commercial activity to improve our stock of properties, upgrade them from the various classes they were to a superior class of asset, and we embarked on such a program last year, in addition to executing on some key acquisitions. So key highlights of 2020, we disposed of 6 units of our South Florida condo portfolio. As you know, that portfolio we've been rebalancing out of the US and out of the individual condominium market. So we disposed of those and put some of that cash and added some of that liquidity to our acquisition plan in places like the Cayman Islands and Jamaica. We acquired a fully tenanted office building in the Cayman Islands. I think we're seeing a picture of it there. It's Harbor Center, as well as approximately 88,000 square feet of warehouse space in Kingston, Jamaica. We reduced the overall cost of our borrowing, again, all in furtherance of preserving liquidity. Part of that is reducing the amount of outflows and our interest expense. So we thought we managed to get an extremely positive reduction in the cost of our gearing, so that now we're borrowing on average at less than 4% per annum. What you as shareholders should be really concerned about, obviously, is our stock price and value, and that improved almost 10% during the pandemic year. A key feature of what we were trying to do as a business. And we also returned liquidity to our shareholders, paid out 66% of net profits as dividends as well. And in addition to dividends, we provided liquidity to shareholders by buying back about 50,000 shares of stock as part of a programmed share buyback policy that we've implemented that essentially suggests that if there are shareholders out there who are willing to sell our shares at book value or less, we are going to pick them up. We think that is a good value for money. So just quickly looking at the stock performance between 2016 and 2020, we've outpaced from a stock price and value standpoint. We've always outpaced book value at varying premiums between 12 and in some cases 40% higher than book value over time. But more importantly, we've outpaced the Jamaica Stock Exchange and its index and average over time. And more recently, what we see is that, the recent participants in that APO I talked about at the end of 2019 would have really gotten a huge benefit and premium on the price. They would have bought into the rights issue at $5.62 at the end of 2019. They'd have gotten an 18% premium on that price by the end of 2019. And then by the end of 2020, gotten a further nearly 9.5% premium again on the original rights issue price. So anybody who participated in the rights issue would have done very well between the end of 2019 and now throughout that pandemic period. And you can see us in the bottom bar graph compared to the stock exchange, where to the end of 2019, stock exchange was up 1.2. We were up 18%. Our stock price was up 18%. And for 2020, the stock exchange was down on average 22.5%. We were up 9.5%. So we clearly outpaced and outperformed the general stock market and index. And then again, what also should really matter is our dividend payout ratio. As you can see, it varied from 38.5% to 76% in 2018 to 66% in 2020 of net profits. And the gross dividends we've been paying out has also continued to steadily improve. In February of 2021, we approved a dividend policy that basically calculated our dividend and dividend payout ratio as a percentage of funds from operations instead of the more sort of IFRS accounting-based net profit. Funds from operations really speaks to the actual cash you are generating from operations. And we believe this is the mark, certainly for a REIT, where the purpose of a REIT is you're really constituted to generate the cash flow you do and then return the vast majority of it to shareholders. We thought it was appropriate to calculate our dividend payout ratio against the actual cash we were generating. So we devised a policy and decided that as a group, we would pay out up to 90% of funds from operation on an annual basis, and we've paid out 64% so far. Next. So what are the main strategic imperatives going forward before Kevin comes up and talks more specifically about the numbers and our performance over the last year? We want to remain resilient. We realize, and if we didn't know before, and we did, but if we didn't, the pandemic certainly made clear that we are living in times that are at best uncertain, and you have to be prepared and be ready to expect the unexpected. And so we have to be resilient. So we have to ensure that we maintain sufficient and adequate levels of liquidity at all times, and that we're constantly thinking about how we're going to future-proof the organization against, like I said, what is certainly a very uncertain future. So like we outlined in our strategic plan of 2 or 3 years ago, how you make yourself more resilient is by ensuring that your capital is robust. So we focused in that strategic plan on capital growth, getting to $10 billion in capital. You enhance resilience again by ensuring that you're geographically diverse. We're focused on that, geographically diversifying our portfolio, and I think you can see that, and we'll certainly see that when Kevin comes up and gives you a more detailed plan or overview of our plan. We're going to leverage strategic partnerships, create partnerships that are going to be force multipliers of value. And we've begun doing that already by partnering with General and, General Partnerships. I'm going to continue to, partner with General Partnerships and other entities that are going to allow us and enable us to, like I said, create additional value over and above the funds that we invest in them because of the quality of the assets that are on the books of the particular partners that we're going to look to leverage. We've begun to do that, and we're going to continue to do that going forward, and we've already seen where it's created force multipliers of value going forward. And then last but certainly not least, again, what the pandemic has taught us, as if we didn't know already, is that we're going to deal in a world going forward that is going to force you to interact with stakeholders of whatever kind, whether it be suppliers or colleagues, customers, remotely. You're going to have a digital presence, and it's going to have to be a robust digital presence. It's going to have to be effective. It's going to have to be secure, right? I mean, I don't have to tell you about the potential for ransomware and all of these other issues. But ultimately, you're going to have to execute on a digital roadmap, and we are well down the road on ensuring that we're able to do that with respect to how we interact with potential shareholders, investors, partners, investment partners, and potentially tenants. So I think next we're going to move now to a more detailed report that our CEO, Kevin Richards, is going to deliver. Kevin, thanks.
Thank you, Chairman, and welcome everybody. Particularly to those who are joining us virtually, we're now in a new norm, and think this is how we're going to be operating going forward, some sort of hybrid where we're physically together as well as dealing virtually. Just continuing from where the Chairman left off, I mean, 2020 was, despite the pandemic, was a fairly good year for us. We hit record revenues of 2.1 million. Our average dividend over the last 5 years is just north of 2%. And from the chart you saw earlier, having changed our dividend policy to 90% of funds from operations, with our growth strategy, we're likely to be generating much higher funds from operations, so expect that average yield going forward to be much higher. We did set out as one of our strategic objectives to get to about 1 million square feet of space under management or ownership. We ended the year last year at just under 300,000, and we expect to amp that up some more. Property portfolio has grown a bit. We're up to 17 properties, and thankfully, with the grace of God, we were able to maintain occupancy during 2020 when a number of other places who are real estate holders were actually losing tenants. We actually were able to maintain our tenants, and that's part of the resiliency that helped us through in 2020. Just quickly on the financial highlights. As I mentioned, we hit record group rental revenue of 2.13. That represents a 26% jump over the prior year of 1.6. Now, the important thing is that although we acquired funds through a rights issue in November or December 2019, the key thing is about how you deploy that money. And we've been deploying that money fairly efficiently. And that is demonstrated in our net operating income and net operating margin. And you can look and see year on year the improvement in net operating income by 53%, as well as our margin moved from just under 40% to 48% in 2020. So we've been efficiently and effectively deploying the funds that we raise. As well, the portfolio has grown. We added roughly about 15.6 million worth of properties last year, bringing the portfolio up to just under $40 million. Again, we've been very judicious in terms of how we manage the expenses. So we mentioned selling or disposing some of the condos in the portfolio. Once you do that, then we're obviously going to be cutting some of our expenses. The two big ones being the HOA fees as well as property taxes in the US, and that also helped us to boost our net operating income and net operating margin. Over the last 5 years, you can see the trend in terms of our revenue. The company's been growing. We've basically doubled our group revenue in the last 5 years, again hitting a new record. And if you look at it from looking at our CAGR over the last 5 years, well, Rental income has grown on average 15% for the last 5 years, while our NOI, which is the key metric that I look at, that's our net operating income, has grown on average at 32% per annum over the last 5 years. We've done a sort of forecasting as to what it would look like, if we extrapolate based on our first quarter performance for 2021, and you can see that CAGR going up even further for this year. Operating income, as I mentioned, that's been steadily growing as well, and funds from operation, a key metric that we use. Now, a lot of people, it's something we repeat, because when you talk about a real estate investment company or a REIT, this is the key metric that is looked at, and it's how much cash you generate in the business, because at the end of the day, you're generating that cash to give back to shareholders. And this is something that we focus on like crazy. It is actually a main discussion at the board level. We talk about how much cash we generate in the business, and that shows you how we've been increasing that metric going forward over the last 5 years. And again, as I mentioned, for 2021, if you are to extrapolate from our first quarter performance, that is likely to be a much bigger number in 2021. Equity has grown, as again, we've set out those targets. As well, we've looked at how we finance our growth. Yeah, we've done a lot of equity raises over the last five to 6 years, but also we've used debt, and we've used debt in a judicious manner. So although debt has grown from 2 million at the end of 2016 to 13 million, this is actually very low cost debt, and as the chairman mentioned, our average cost of borrowing is now less than 4%, thankfully because of continued low interest rates globally. Margin has been improving. Again, it's how we've been judiciously managing the funds that we have in terms of how we deploy into real assets. We still think we're fairly conservative in how we invest. Our loan to asset ratio, 30% at the end of 2020, and even from a loan to equity standpoint, it's less than 50%. And there is still a lot more room for us to increase debt while still maintaining adequate cash levels. Just quickly looking at our portfolio, as you know, we're in Jamaica, the Cayman Islands, as well as in Florida. Property portfolio has been growing, 2.5 times over the last 5 years. Your company has been growing aggressively. And we've also been doing shifts in, how we spread between different jurisdictions, amongst the different jurisdictions, mainly Jamaica, Cayman Islands, and the US. We first entered the Cayman Islands in 2017, and we're very happy with the performance in that market, and that would justify why we're at 42% as at the end of 2020. Just a quick breakdown of the portfolio. The two largest properties in the portfolio would be the Harbour Center property, which we acquired in the Cayman Islands July last year, coming up to 1 year now. And then the other one would be, the two others would be the Red Hills Road property and the Grenada Crescent office building, both in Jamaica. We also look at the profile of our tenants, because that's part of our risk management and risk assessment. And we look at what industries they are operating in, because at the end of the day, we have to assess how those industries are doing to know how those tenants are going to perform. Will they be able to make rent when they need to? One of the things that was good for us in 2020 is that 21% of our tenants were governments, whichever of the jurisdictions we operate in. And one thing, governments pay their rent. We had very little exposure to hospitality, and that was mainly in the Cayman Islands and to some extent in Florida with our condos. And the other major area would be technology, as well as persons in the logistics industry. More currently, the shift has moved to about 51% in Jamaica, 41% in the Cayman Islands, and the US has shrunk to 8%. We did buy properties, we continue to improve them, but our spread largely right now is 50% office, 36% in industrial properties, and 10% in residential, and a small bit in retail. Ideally, we'd like to shift that industrial portion to a much higher percent, and that's part of the main goals going forward, and we will talk about that a little bit later on. As I mentioned earlier, occupancy. And I can report that as of now, we are 100% occupied in all of our properties in every single jurisdiction. And I think that's a huge achievement, especially in a time of pandemic, for us to achieve that. A second important thing is that collections has been good as well. We've not had gone much below 90% in terms of collections. We've had to extend some sort of moratorium to some tenants when the pandemic just hit, but most tenants are current, and whatever moratorium that was extended to them, they've covered all of that. So we've been very happy in terms of how we've been able to generate cash from our tenants. And I think it speaks to the level of due diligence that we put in the tenant selection, and that's paying off for us. Another thing that we jumped into in 2020 was private equity, and I think this is going to be the area that we're going to be doing a lot more going forward. We partnered with a firm called CGI Merchant Group out of Florida, and they primarily invest in Class A value-add office buildings in Southeast Florida. And they have, approximately 1 million square feet of office space, and they're growing. And we've had a very good performance from this investment year to date, and we're happy about this. And as I said, we're going to be doing a lot more going forward. What's next for us? I mean, you can see the term repeated, growth and resilience, growth and resilience. Last year we talked a lot about resilience because that's what is going to ensure that, we've been doing this for 13 years, and we want to ensure that we're still doing this for another 13 years, and 13 years after that, and 13 years after that, and 13 years after that. So it's very important that we stay as a going concern. So it's important that we grow, but also remain resilient. One of the things that, as me, even as a personal investor, what is important is return on investment as well as return of investment. So, we're not going to be some sort of here today, gone tomorrow sort of entity. So it's very important that we have a long-term vision and carry on with that. And as I mentioned, we've been doing this for 13 years, and when we started in 2008, there weren't a lot of listed companies that were actively participating in the real estate investing space. Now that landscape has changed a bit, but I need to let it very clear that people understand what our identity is. KP is a company that invests in value-add real estate, primarily in the industrial, office, residential, and a new era, the mixed-use space. Value-add strategy is what is the thing that makes us money, and I'll go into it a little bit more. The thing that frames how we operate going forward is what are some of the macroeconomic currents that are facing us, how are we going to deal with them? And we look at growth because we primarily target jurisdictions where growth is strong or projected to be strong. We're in Jamaica, we're familiar with Jamaica, projected to grow at between 3.6 and 4%, depending on which institutions' projections you use. But more importantly, the Cayman Islands and the US are two economies that are projected to come out of the pandemic much faster than many other economies, and they're projected to grow at north of 5%. In the case of the US, 6.7% is what the projection is. Another thing that we focus on when we look at investments is how well a company is, how well a country ranks on the ease of doing business index. So that's a huge determinant in terms of where we go with our investments. We expect interest rates to remain low. I know there's a lot of talk about inflation in the US. I personally think a lot of that is driven by pandemic-related events. And I think the Fed is going to continue to watch and see how those play out before they make any moves in terms of interest rates. But we anticipate that interest rates, at least for the next year, will remain low. Once interest rate remains low, then it's going to continue to fuel the real estate industry, and that is why if there's any other time in our history that I'm optimistic going forward, it is now. What's happening in the real estate space is that we tend to observe what are some of the trends. Where is it that we should be looking at? What's going to guide our strategy going forward? And there's a huge demand for logistics and warehousing facilities. Data centers have risen, and a lot of the demand for warehouses and logistics centers is because of how e-commerce has grown. So what you find is that a lot of people are now demanding huge amount of space for warehousing. If you look at a country like Jamaica, for example, that has a very high propensity to import, there is always going to be a need for warehousing space, and that is why that is our main focus in going forward in terms of building the portfolio. There's also an interest in co-working spaces. It's something that we have looked at for some of our properties. We have the good fortune, I guess, of being fully occupied, so we have no capacity to do it. But going forward, it is an area that we're looking to participate in. We're happy to do it jointly because CGI, for example, has their own co-working model, and I think it's a model that is consistent with what we like and want to pursue. Certainly in the US, there's a shift back into multifamilies, and one of the things that people need to understand is that even if interest rates go up, interest rates rising is actually a plus for multifamilies because persons who would normally buy properties would, if interest rates are higher, then they'll probably put off that purchase and instead decide to rent. So there is a push back into residential multifamilies, particularly in areas that are, what they call low cost to live areas. And we've seen the shift in the migration patterns in the US. People moving from the Californias and the New Yorks and going to Florida where there's zero state income tax, or they're moving to Nevada, or they're going to Georgia or North Carolina or Texas, Tennessee. So we're targeting those specific markets where we see the migration patterns are shifting towards. Certainly locally and regionally, we've seen a huge increase in the number of construction of mid-rise. I call them mid-rise properties. I don't think we have any high-rise properties in Jamaica. They're mid-rise properties. And that's a trend because, we're an island, so we're all running out of space. A small island like Cayman itself has to relook at the height restrictions that they had imposed in the past because there's a limited amount of land. So there is a trend towards the construction of mid-rise properties. What we saw even before the pandemic is an increase in the demand for what we call flex space or mixed-use space, like a warehouse office combination. And that is also another area that we're targeting for our investments. And that final item is something that we've talked about at our board level for quite a while now. And it is really the concern that people have about the environment. And you've seen the growth in impact investing globally because there are a lot more persons who want to put their funds towards things that benefit the environment or at least don't hurt the environment. And you see that being reflected in terms of the type of spaces where they work in or the type of spaces that they live in. And that is going to be a key focus for us going forward. So are we going to execute on that? Through our conventional investing. What we've always done, buying properties in various jurisdictions. We are looking at a number of things currently. Hopefully we can make an announcement on one transaction by the end of this week. But we're looking at acquiring a multifamily property in the US in short order. In addition, we're looking at acquiring some properties in Jamaica that will be targeted for warehousing and logistics, as well as mixed-use spaces. And we're going to do it in a number of ways. What is going to be key for our growth is doing more joint ventures and deal syndications. We're going to be looking at acquiring bigger properties with other partners doing that. We've started with one transaction. We're about to do a second one. And this is the model that we're going to be using going forward. There are a number of transactions that we are looking at that are in our pipeline that will be suited for this, and hopefully we'll be able to execute on them in this financial year. Green certification. I talk about the environment. We're also, as a huge target, hoping to get to by 2024 to have all of our properties green certified. We have started that process already by looking at several of our office buildings, mainly the Grenada Crescent building, and we're going to be ensuring that we get those properties certified by an internationally recognized and accepted entity to get green certification. Now, a lot of people think that there isn't a profitable way to do that, but as I said, there's a shift in mentality. There are more persons who are interested in, there are many corporations have that as part of their policy. So in terms of the spaces that they tenant, they want to be sure that those buildings meet certain requirements, and certainly that is something that is catching on in Jamaica and is something that exists in Cayman. So that's why we're hoping to get to 100% of our properties by 2024 to be fully green certified. We'll continue the geographic diversification. I've spoken about this ad nauseum, about our need to move away from the hurricane corridor. We're in Jamaica, the Cayman Islands, and Florida, three countries that are susceptible to these events. And that's why we're looking at spreading our reach in the U.S. And I mentioned some of the states that we will be looking at in terms of our geographic diversification strategy. And our building out our digital platform. We have been working on a digital platform that is going to be very interesting, to say the least, a little bit disruptive, I think, in our market. And we're hoping that we'll be able to make some disclosure on that within the third quarter, by the end of the third quarter of 2021. But this will be a very exciting project, and something that is going to help us in terms of our strategic goal of growing our equity, and it is an interesting way for us to look at how we expand the portfolio. Another component of it is really how we interface with our tenants and all of our other stakeholders, and that those stakeholder groups include our shareholders. So we'll continue to pursue some commercial real estate spaces. As I said, value add is our key strategy. That's how we make our money. We're looking at acquiring companies, as I said, through partnerships. We're going to be expanding our reach into different markets and acquiring larger properties. And we're going to, of course, have to continue to fundraise. We did mention that earlier this year, the shareholders, you approved the increase in our share equity and for us to go and raise additional funding. And that is something that we are actively pursuing, and we're fairly close to finalizing that. So fundraising. That's typically what a REIT does. You fundraise, buy properties, sell properties, rinse and repeat. Our portfolio is split up in a number of ways. You have core or stabilized, value add, opportunistic. I know I've been talking about value add a whole lot, but let me explain that the value add is basically a property that we've identified that is perhaps poorly managed in a very good location. So there's a huge potential upside because, it's a lot of under-market rents. Currently, that represents about 43% of our portfolio. Core is where earnings are completely stabilized. You don't really have to do much changes to the portfolio. We're going forward, we're making a slight shift, which means looking at more greenfield or opportunistic projects. Those are ground-up developments. This is not something new to us. We've looked at that before in the past. If you recall, we had acquired a 20-acre property in Westmoreland maybe about 6 years ago, with the aim of developing that for low-income housing. And we always wanted to do some type of ground-up development. We were just waiting for the right partner to deal with it. I think we are moving swiftly in that direction. Our first acquisition towards that goal was the purchase of the Dumfries property, which we did in the first quarter of 2021, which we'll be developing that property. And there are some other opportunities that we are at various stages of execution, sale agreement, due diligence process. So we're likely to make some announcements on that in short order as well. So the shift would see us moving to about 15% of the portfolio in those greenfield or opportunistic types of projects. Stabilized or core would be at 20%, and our value add at 65%. And let me just give you a quick case study of the value add and how that benefits us. A case is the Grenada Crescent building, which we bought at roughly about 3.6 million US dollars. We've gone in, done some improvements, changed the tenant base, and we're still doing some improvements, and even at the end of that improvement, we should see another bump up. But in 2 years of that, we saw a 50% increase in the valuation. So value add is a very important part of our business because A, you cash flow from day one, and generating cash is very important to our business, as opposed to if you do sort of greenfield developments, which takes a little bit of time before you get to cash flow. So we will continue to be doing for projects. The Spanish Town Road properties are similar one to that, or Red Hills Road properties are similar one to that, or Ashnaim Road properties are similar to that, similar property to that. So this is sort of what's going to form the large component of our business going forward. On our green policy, as I mentioned towards, that's something that we're very serious about. We have been active for years in terms of what we do in relation to the environment, and we're going to continue to do that. But more importantly, we are amping that up and getting to green certification for our properties going forward. We were featured recently in the Sustainable Business magazine for our efforts in that goal, and that is something you can see. There's a link to it on our website. And that pretty much sums up my presentation. If there are any questions, I hand back to the chairman, who will take them.
Thanks, Kevin. So normally we'd have gone into Q&A, but what I thought was that before Mr. Staple kicks off the bowling, was that we would go right into the reading of the financial statements by our auditors. For Mr. Staple's benefit, we're going to read the audited financial statements in their entirety, after which we can dive into Q&A, but we're going to call our auditors up here now to go through the process of reading the financial statements. Then we'll go into Q&A. Karen?
Good morning, everyone. I'm Karen Raghaber Singh from KPMG. Independent Auditors Report to the members of Kingston Properties Limited. Report on the audit of the financial statements. Opinion. We have audited the separate financial statements of Kingston Properties Limited, the company, and the consolidated financial statements of the company and its subsidiaries, the group, set out on pages 64 to 104, which comprise the group's and the company's statements of financial position as of December 31, 2020, the group's and the company's statements of profit or loss and other comprehensive income, changes in equity and cash flows for the years then ended, and notes comprising significant accounting policies and other explanatory information. In our opinion, the accompanying financial statements give a true and fair view of the financial position of the group and the company as of December 31, 2020, and of the group's and the company's financial performance and cash flows for the year then ended, in accordance with International Financial Reporting Standards, IFRS, and the Jamaican Companies Act. Basis for opinion. We conducted our audit in accordance with International Standards on Auditing, ISOs. Our responsibilities under those standards are further described in the auditor's responsibilities for the audit of the financial statements section of our report. We are independent of the company in accordance with International Ethics Standard Board for Accountants, International Code of Ethics for Professional Accountants, including International Independent Standards, IESBA Code. And we have fulfilled our other ethical responsibilities in accordance with the IESBA Code. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. key audit matters. Key audit matters are those matters that, in our professional judgment, were of the most significance in our audit of the financial statements of the current year. These matters were addressed in the context of our audit and of the financial statements as a whole, and informing our opinion thereon, and we do not provide a separate opinion on these matters. Key audit matters and how they were addressed in our audit. Valuation of investment property. The valuation of the group's investment property requires significant estimation, which is impacted by uncertainty of market factors, pricing assumptions, and general business and economic conditions. Our audit procedures in response to this matter included the following: using our own valuation specialists to assess the reasonableness of the valuation methodologies employed by management, including management experts where applicable, and the fair value conclusions for a sample of properties at the valuation date. We considered the provisions of IFRS 13, fair value measurement, reviewed the sources of data and underlying assumptions utilized to value the properties, performed a search for similar transactions and listings, and performed market participant interviews to assess potential fair value changes that occurred within the period. Evaluating the independence and qualification of management's valuation experts where applicable, to determine that the valuations were done with appropriate independence and free of management bias. Assessing the adequacy and appropriateness of the group's investment property disclosures, including the valuation techniques and significant unobservable inputs in accordance with IFRS 13 fair value measurement. Other information. Management is responsible for the other information. The other information comprise the information included in the annual report, but does not include the financial statements and our auditor's report thereon. The annual report is expected to be made available to us after the date of the auditor's report. Our opinion on the financial statement does not cover the other information, and we will not express any form of assurance conclusion thereon. In connection with our audit of the financial statements, our responsibility is to read the other information identified above when it becomes available, and in doing so, consider whether the other information is materially inconsistent with the financial statements or our knowledge obtained in the audit, or otherwise appears to be materially misstated. When we read the annual report, if we conclude that there is a material misstatement therein, we're required to communicate the matter to the Board of Directors. Responsibility of management and the Board of Directors for the financial statements. Management is responsible for the preparation of financial statements that give a true and fair view in accordance with IFRS and the Jamaican Companies Act, and for such internal control as management determines is necessary to enable the preparation of the financial statements that are free from material misstatement, whether due to fraud or error. In preparing the financial statements, management is responsible for assessing the company's ability to continue as a going concern, disclosing as applicable matters relating to going concern, and using the going concern basis for accounting unless management either intends to liquidate the company or to cease operations, or has no realistic alternative but to do so. The Board of Directors is responsible for overseeing the group financial reporting process. Auditors' responsibilities for the audit of the financial statements. Our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion. Reasonable assurance is a high level of assurance, but is not a guarantee that an audit conducted in accordance with ISAs will always detect a material misstatement when it exists. Misstatements can arise from fraud or error and are considered material if, individually or in the aggregate, they could reasonably be expected to influence the economic decisions of users taken on the basis of these financial statements. A further description of our responsibilities for the audit of the financial statement is included in the appendix to the auditor's report. This description, which is located at pages 62 to 63, forms part of our auditor's report. Finally, report on additional matters as required by the Jamaican Companies Act. We have obtained all the information and explanation which, to the best of our knowledge and belief, were necessary for the purposes of our audit. In our opinion, proper accounting records have been maintained so far as appears from our examination of those records, and the financial statements, which are in agreement therewith, give the information required by the Jamaican Companies Act in the manner required. The engagement partner on the audit resulting in this independent auditor's report is Karen Ragabear Singh. Signed by KPMG, Chartered Accountants, Kingston, Jamaica, March 1, 2021. Appendix. Oh, okay. All right. So pages 62 and 63, the appendix to the independent auditor's report. As part of an audit in accordance with ISAs, we exercise professional judgment and maintain professional skepticism throughout the audit. We also identify and assess the risk of material misstatement of the financial statements, whether due to fraud or error, design and perform audit procedures responsive to those risks, and obtain audit evidence that is sufficient and appropriate to provide a basis for our opinion. The risk of not detecting a material misstatement resulting from fraud is higher than for one resulting from error, as fraud may involve collusion, forgery, intentional omissions, misrepresentations, or the override of internal control. We obtain an understanding of internal control relevant to the audit in order to design audit procedures that are appropriate in the circumstances, but not for the purpose of expressing an opinion on the effectiveness of the group's internal control. Evaluate the appropriateness of accounting policies used and the reasonableness of accounting estimates and related disclosures made by management. Conclude on the appropriateness of management's use of the going concern basis of accounting, and, based on the audit evidence obtained, whether a material uncertainty exists relating to the events or conditions that may cast significant doubt on the company's ability to continue as a going concern. If we conclude that a material uncertainty exists, we are required to draw attention in our auditor's report to the related disclosures in the financial statements, or, if such disclosures are inadequate, to modify our opinion. Our conclusions are based on the audit evidence obtained up to the date of our auditor's report. However, future events or conditions may cause the company to cease to continue as a going concern. Evaluate the overall presentation, structure, and content of the financial statements, including the disclosures, and whether the financial statements represent the underlying transactions and events in a manner that achieves fair presentation. Obtain sufficient, appropriate audit evidence regarding the financial information of the entities or business activities within the group, to express an opinion on the consolidated financial statements. We are responsible for the direction, supervision, and performance of the group audit. We remain solely responsible for our audit opinion. We communicate with those charged with governance regarding, among other matters, the planned scope and timing of the audit and significant audit findings, including any significant deficiencies in internal control that we identify during the audit. We also provide those charged with governance with a statement that we have complied with relevant ethical requirements regarding independence and communicate with them all relationships and other matters that may reasonably be thought to bear on our independence, and where applicable, actions taken to eliminate threats or safeguards applied. From the matters communicated with those charged with governance, we determine those matters that were of most significance in the audit and the financial statements of the current period, and are therefore the key audit matters. We describe these matters in our auditor's report unless law or regulation precludes public disclosure about the matters, or when, in extremely rare circumstances, we determine that a matter should not be communicated in our report because the adverse consequences of doing so would reasonably be expected to outweigh the public interest benefits of such communication.
Boy, well done, Karen. If we had more time, I'd make sure we give you a round of applause, led by Mr. Staple, I'm sure. So we're open for questions, Q&A. Right now. No. By a show of hands, Mr. Staple's hand was up first, and I'm sure it's going to be exhaustive. So let's get Mr. Staple done. Morning, sir. Morning, Mr. Staple.
I have just three observations I would like to share. So with your permission, sir, I would like to share those three observations. First of all,
I'm going to beg you to make them as brief as you possibly can.
First of all, loving God of creation, as a group we come before you this moment, giving you thanks for taking us safely to this meeting. We thank you for the many blessings you have given us over the last year, despite the challenges we face at home and at the workplace. You are our good shepherd, who, despite the oversight of the flock, goes out to find the lost sheep, and when you have found it, brought it back and rejoice with those around. The challenges are many, but you have made us strong. Thank you, Lord, for our chairman, our members of the board, hard-working employees and shareholders. Father God, we invite you into our midst this moment and ask you, Lord, to guide our thoughts and our actions. And as we discuss the affairs of our company, help us all to appreciate each other's inputs. Kindly take us safely to our various destinations after this meeting, and may your continued blessing be with us all. This we ask in Jesus' name.
Amen.
Mr. Chair, congratulations to you and fellow board members, the hard-working employees, for the impressive results presented to us today. Very careful and impressive corporate objectives, which has enabled us as shareholders to have hope despite the many challenges in our country and in the world. Thanks to you all. Very informative management and discussion analysis. Thanks to the team leaders, to the team members led by Mr. Kevin Richards. You are You all performed exceptionally well. Kevin, Andre, Roxanne, Tatisha, Ramon, and Sashay Gay. God's blessing be with you all. And lastly, thanks to the auditor for at least going through to the details of this as instructed by the chairman. Thank you, Mr. Auditor. Mr. Chair, my first question on page 83. What accounted for this significant increase in brokers' fees from $66.7 thousand US dollars versus $30.25 thousand? Your comments?
83 brokers fees doubled.
Yeah.
Yeah, just more sales, more disposals. Mr. Staple, brokers fees are just a function of disposing of property. And so we had some additional, as we mentioned in my report, we had some additional and accelerated disposals last year. I don't know if Kevin want to add to that.
Sure, the leases.
And
Properties are 100% leased.
so broker fees also accrue to finding lessees for our properties as well. And as Kevin mentioned in his report, we're 100% occupied now and leased. So again, just additional activity in both disposing of property and ensuring that properties that we have under our management are fully leased meant that we spent a bit more to get that done.
Thank you, Mr. Chair. Page 85. Explain why this high level of increase in key management compensation from $227,000 US in 2020 versus $147,000 in 2019. Why?
That's a good question. No, I'm kidding. No. So we as you know, or should know, Mr. Staple, have added additional capacity, management and leadership capacity to the business. And we also execute an incentive-based compensation scheme so that management and the leadership of the business are incentivized to generate both higher and higher profits, more and more funds from operation. And indeed, we also tag a bit of that compensation to the improvement in our share price as well. All of the things that are perfectly aligned with what shareholders would reasonably expect. And so because our performance has improved and will continue to improve, I believe, if we continue to align the interest of management and our shareholders the way we have, you're going to see as results improve, so will the compensation to management and leadership of the business, as we think should be the case. We're careful though to make sure that it stays, that ratio stays within international norms, but we think it is the way to continue to remunerate management and leadership generally.
Page 98. What has resulted in this increased credit impairment of $29.9 thousand US dollars?
Increased
impairment.
Impairment.
Credit impairment of $29.9 thousand US dollars. Explain.
In 90, where is, oh, okay, right. More than 60 days?
Yes.
You mean the more than 60 days past due?
Yes.
During 2020, that is, that was, I'm not sure what that number represents exactly, or why it is at that price, at that level. Eh? Yeah, man. That's the ECL. Oh, it's the ECL? Yeah. So as you know, expected credit loss is a requirement now of IFRS. So regardless of the actual credit performance of an underlying asset, you are required now under IFRS to provide an ECL provisioning for all of your assets under management. So that continues to accrue. It's a non-cash, as you are aware, I'm sure, Mr. Staples, a non-cash expense. Don't mean that money has actually gone out, but it is a prudential reserve or provision against any asset that you acquire, regardless of its actual credit worthiness and its payment history. And so it continued to go up as we acquire more and more property.
Mr. Chair, last question. On 64, page 64. In 2019, you had total revenue of $3.7 million US dollars. And that 3.7 million total revenue, everything, total revenue. That 3.7 million revenue cost you 1.5 million US dollars. That gave you a net profit of 2.199 million US dollars in 2019. For every dollar that you spent in 2019, for every dollar you earned in 2019, your expense was 49 cents and your profit was 59 cents. In 2020, your earnings, your revenue, total revenue was 2.8 million US dollars. And that 2.8 million US dollars cost you 2.2 million US dollars, which gave you a net profit of 612,000 in 2020. For every dollar that you earned in 2020, you spent 78 cents, and your profit was 22 cents. Now, we understand, Mr. Chair, that 2020 was a challenging year. But what could have really allowed us to fall way down in our profit of 612,000 US dollars? Why? What could have really happened? Could it be all COVID?
No. That is an interesting way of looking at it, Mr. Staple. But again, as you are aware, our 2019 revenue would have been considerably enhanced by 1.6 million in the revaluation of properties, right? Again, a non-cash impacting income line, and as usual with non-cash impacting income, have had no attendant expenses that would have accrued to that income line at all. So we picked up 1.6 million in income or in appreciation in 2019, no attendant expenses. So as you pointed out, that would have looked like a very, very efficient way of growing income. In 2020, we had more of cash-based revenue. In other words, very little in building appreciation. Pretty much 2020 is all cash revenue with all attendant expenses accordingly. So that what happened there is that cash revenue minus cash expenses gave us the 600,000 in revenue. And if you look at our cash flows statements, which, you know, an astute investor like you pays a whole heap of attention to, you will see that from a cash generating standpoint, year over year, we generated slightly more cash in 2020 than we did in 2019. So while that is a correct way of looking at it from an overall IFRS standpoint, if you look at what actually happened on the ground, 2020, way more cash-based P&L, didn't have a ton of appreciation or revaluation gains there. 2019, $1.6 million in revaluation gains. Prudential revaluation gains, I don't want to denigrate revaluation gains because they are part of a structured policy that we have established for revaluing property on an intermittent basis every 3 years, I think it is, property by property, and it is based on private professional valuations. But when it occurs, it generates all this non-cash upside without any attendant expenses. So you look way more efficient that way.
Thank you very much, Mr. Chair. And I would also like to thank you, Mr. Chair, for having us today in this meeting. The protocols have been observed. Everybody has on the mask, sanitization, and spacing is important. We thank you, Mr. Chair, for having us in mind and for getting us here as shareholders to participate in our annual general meeting. Thank you very much.
Thank you, Mr. Staple. Appreciate it.
Yes, Mr. Chairman, Livingston Young.
Yes, Mr. Young.
Shareholder. I can turn to page 29 for please.
29.
Management discussion and analysis. You there, Mr. Chairman?
Yeah, man.
I have a thing for this gentleman. I've seen picture myself on it. You see, I have in Cayman Islands and 2019 of, you hear me? You hear me, sir? Yeah, 2019 with 30% to 40%. Like in Kingston, have a building or something like a building location in Kingston. You can explain to me, like how the devaluation of the Jamaican dollars continue going on all the way. Explain to shareholders how can you do everything in US, most of the thing, the board currency. Explain how you have to manage Jamaican and the US dollars. You all can explain.
Yeah, no, our rents are all denominated in US dollars, regardless of where the buildings are located. And even where we collect, in some cases in Jamaica, Jamaican dollars, those contracts are pegged to the US dollar so that we have programmed increases in the J dollar value of those rents year over year to mirror any potential devaluation that occurs in the J dollar. So all of our rents are either directly received, even in Jamaica, in US dollars and contracted as such, and where we do get J is pegged to US.
So what you're saying to Mr. Chairman, say no Jamaican dollar, just be a US?
No. There are some tenants who are paying in J dollars in Jamaica in some of our buildings. I'm saying those contracts though are pegged to the US dollar. So the rates of leases in J dollar terms revalue with any revaluation of the
yes, Mr. Chairman,
Jamaican
this
dollar.
guy it's weird because our dollar we keep constant declining.
No, man, exactly.
So may I say, boy,
We peg it. We peg it. So we either get US or we peg any J we receive to the US dollar.
Where's the miss?
What I'm saying? No, what I was just reminding the chairman in another way is that what he's saying is every time the dollar devalues, it doesn't have any impact on our leases.
You sure?
It doesn't have any impact because since I see the contracts, what the contracts are saying is that it's fixed to an exchange rate in the US dollars. So if the dollar go down, we save. If the dollar go up, we save.
All right. You can turn to page 66, please. Yeah, page 66. Share capital, tenants. You there? December,
Yes,
December, the balance at December 31st, 2018. Share 10,939,563 cents. And the tenants are 4,172,000. You can explain to me the profit for the year being total income achievement. Explain to me, sure, this dash. Explain the equivalent to me, please.
Which that's the profit for the year being total comprehensive income?
Yeah, right. Income, yeah.
Yeah, that's how much profit we made for the year. Over under the line called retained. You see the column called retained earnings?
Yeah.
Yeah, that has the 2.199 million on it.
Yeah.
That was our profit for the year, 2020, and that goes into the statement of the equity section of the balance sheet. Profit goes into the retained earnings section, and these are the other sections of the equity component of your balance sheet. Share capital, treasury, cumulative translation reserves, and retained earnings. The profit goes in the retained earnings section.
Because you jump down a little bit there. It's the tenants with owners of the transaction between owners of the company. Share capital was 6,100,000.
Yeah, those are treasury shares. Those are treasury shares. So when we buy shares back from existing shareholders, you characterize those as treasury shares and show the movement of that in your equity section. Because you're dealing with your owners, basically, and you're buying shares back. So you buy them back and retire them.
Hold on, I have something. I have a page. I'm going to see if I can find it. It should not slip me. Gosh. I have a page. Lord, no, I didn't find it. All right. I can turn to page 83. Expense by nature. The group and the company. You see, Mr. Chairman?
Yes, sir.
You have accounting fees, audit fees, banking charges, bank fees, brokers fees, and descriptions, note 9, director's fee, employees tax, and you add up all these fees. 1,148,000, 40, yeah, yet two. Explain to it as shareholders and others operating expense. Give a little explanation, please. All these fees, add them up.
Other operating expenses
Because
just
hold on,
missing.
Mr. Chairman, you have 2020 and 2019. Just give a little running on it.
Yeah, so other operating expenses are just miscellaneous expenses, basically, of varying kinds, where we describe the precise expenses that we are talking about are in the lines above. And when we go to other operating expenses, those are, a combination of a bunch of miscellaneous expenses in running the business that add up to those numbers. I thought what you were going to point out was that year over year, expenses only moved up $84,000 just year over year. So we're keeping the cost of running this business flat, basically, which is what I thought you were going to point out. But
You see this fees, Mr. Broadcast fee of 66 million in 2020. 66,000, yeah. You see that, Mr. Chairman?
yeah, man.
And when you add up all the description fees, note 9, that's upon the other side.
Yeah. So we spent $1.1 million in 2020. Spent $1,016,000, 84,000. Very little difference. So we're basically running this company for the same amount of money year on year, which I think is highly efficient.
Yeah, all right. Thank you, Mr. Chairman.
Yeah, man. Sure. If there are are there any further questions?
Good morning, everyone. So we have some questions coming in on our online platform, mostly from David Rose, and he says, "Good day, Mr. Sinclair. With respect to your U.S. acquisition and U.S. targets, how is this progressing with the consideration of the $700 million bridge loan?"
Right. So bridge loan has been concluded by and large, and acquisitions are continuing as usual, opportunistically, in the categories and as geographically diversified as was mentioned in the CEO's report. Obviously, we can't make insiders out of everybody by saying exactly where we're making those acquisitions and how we're going to deploy those funds. But I can just tell David that that things are progressing according to plan. And just stay tuned for announcements to come, some of them fairly imminently.
And the next question is the prospectus at the FSC right now for the APO?
It is, or close to being. I know we have concluded our side by and large. So sorry, CEO reminds me that it's still with the lawyers, but should get to the should get down to the regulators imminently.
Okay, and will this APO have shareholders been given an appropriately designated pool?
Not that I'm aware of, no. We have not. Some in executing on APOs have done that. We're just going to offer every shareholder same price. And I believe that if recent history is anything to go by, shareholders of all sizes, shapes, have done very well based on the difference between the last APO price and where we are trading today. So we're going to set a price and everybody going to come in at that same price.
Okay, and as a follow-up to the bridge loan, he's asking what's the progress of the deal surrounding the $700 million bridge loan. He's not asking for the exact details, but the status, which isn't material.
Yeah, it's funding, and it's being done in anticipation of an APO to come, which we are towards the end of the process of. So it is just treasury. It's treasury management. It's needing to conclude acquisitions from a timing standpoint, and it contemplates an eventual APO that, like I keep saying, is pretty. We hope is fairly imminent.
Okay. And he's making a suggestion. Can KPREIT going forward put a table in their quarterly and annual reports with the occupancy of each property along with other KPI details like the type of lease, the property focus, the square feet, etc.? Another question, he said you renamed your St. Lucian subsidiary. What's the current status surrounding possible increased costs to meet the economic substance in St. Lucia?
Yeah, it's an excellent question. We are certainly in the midst of, finalizing our due diligence on precisely that point. We are well aware. We have a couple of things. We have some excellent advisors in St. Lucia on who we're going to rely. And we're in the process right now of determining exactly how we navigate these economic substance rules, these new economic substance rules and requirements. So there will be more to hear on that in the future. But suffice to say, we are all over that issue.
And coming down, he's asking again, is your U.S. subsidiary a Delaware C Corp or just a company incorporated in Florida? And will you be incorporating a new subsidiary for the U.S. expansion?
So the answers to all of those are no, no, no. It is not a Delaware C Corp. We're not contemplating setting up any new special purpose vehicle in the U.S.
And finally, based on your investment into Grenada Crescent, how much more in terms of per square foot rental income have you been able to derive?
In Grenada?
Yes. Grenada Crescent, yes.
Yeah, that's a good question. We are now fully occupied there, as we've said, and we've upgraded the property. So are getting, what I would say is, unless the CEO want to add anything else, is we're getting full market rates now for a property of that caliber and location right now from our tenants. But I don't know if you want to add anything, Kevin.
Yeah, so rents are 3 times what it was when we acquired the property.
Right, so basically the CEO said that rents are up 3 times.
Yeah.
That's it, no more questions coming in. Oh, another one. Are there any updates on the Ashenheim property?
Updates on Ashenheim, the existing Ashenheim property?
Yes.
So we continue to upgrade Ashenheim as we have done. The program we've embarked on for upgrading all of our properties continues with East Ashenheim. And by the time we are done with that property, it's going to be pretty much transformed, and it too is 100% occupied and commanding market rates for that location.
That's it. Thank you, sir.
All right, great. Thank you. So if there are no further questions, then we move now to vote on the actual resolutions themselves. And is that something that I carry us through, Madam Secretary? Or? Okay. All righty. So resolution 1, that the audited accounts for the year ended December 31st, 2020, along with the reports of directors and auditors circulated with notice convening the meeting, be and are hereby adopted. Can I have a proposer? Mr. Staple. Can I have a seconder? Mr. Livingston Young. Those in favor? Aye. Those opposed? The ayes have it. Sorry. It's tough. It's tough to run the meeting and click. I should have a resolution 2, that the interim dividend of US $0.00059 per share paid on August 10th, 2020 be and is hereby declared as final for the year ended December 31st, 2020. Could I have a proposer? Mr. Peter Reid, a seconder. Mr. Staple. Those in favor? Aye. Those opposed? Okay, then ayes have it. Okay. All right, Mr. Livingston Young opposed. I think the ayes have it, though. In any event, resolution number 3, that Garfield Sinclair, retiring by rotation, be and is hereby re-elected. I hope I have a proposal. Yes, Mr. Staple. Yeah, man, but hold off on that. We know you voted yes. So I'm going. Yeah.
All right, in relation to the resolution, resolution number 3 in relation to that resolution be moved that Garfield Sinclair retiring by rotation be and is hereby re-elected. All in favor? Aye. Those against? No. Good. Resolution number 4 that Gladstone Lewis retiring by rotation be and is hereby re-elected. Those in favor? Aye. None against. Good. Resolution number 5 that Philip Silvera retiring pursuant to Article 105 of the company's Articles of Incorporation be and is hereby elected. Those in favor? Aye. Against? No against. Resolution number 6 that Resworth Burchinson be and is hereby elected. Those in favor? Aye.
Madam Chair, you can't say all in favor. No.
Okay, those in favor, but as a point of order, sir, we have actually reached this point. You can raise it as the next.
You ask the question, those in favor, those against.
Okay, sir.
That's the procedure.
Okay, thank you. I'll be guided by you. All right, those in favor? Aye. Those against? Good. All right, that's passed. And for the record, all of the other resolutions have been passed. Resolution number 7, that KPMG, having signified their willingness to continue in office as auditors, the directors be and are hereby authorized to agree to their remuneration in respect of the period ending with the next annual general meeting. Those in favor? Against? No against. The resolution number 7 is passed. All resolutions have been duly carried.
So, we've largely done with the formal section of the AGM. It's just left for me to make some closing remarks. Now we're going to continue to seek out selective acquisitions, build a more and more resilient and future-proofed organization. We're going to continue to invest in diverse geographic markets, and hopefully we're going to continue to, hopefully all of that will continue to allow us to deliver competitive risk-adjusted returns to our shareholders. I also should say that we anticipate, as we have been saying, coming back to the market this year for another APO. We hope we are going to find a receptive capital market, and we believe that our track record of delivering for shareholders in the past who have participated in successive APOs would recommend again an receptive capital market. So I want to thank you for attending our AGM. Yeah, Mr. Staple, quick question. Yes, sir.
I would like for you, sir, to continue observing the protocols and continue to have us as part of your meetings. Forget technology. Forget technology. I'm not saying that you must put away the technology totally, but when it comes to our meetings here, we would like to participate, and we would appreciate it to continue having us come to your meeting where we can participate in the meeting. And thank you very much for today's participation.
Thanks, Mr. Staple. Yes, Livingston.
It's upon the dividends. So Chairman, I ask you, you can increase the dividends and a quarter dividends. Understand? To look at that point, please. As a small man of shareholders.
We will take that under consideration, sir, for sure.
Remember, we paid in the first quarter equivalent to what? No, the only thing I'd add is that remember we've paid in the first quarter equivalent to what we paid in all of last year, and we've just declared another dividend.
Well, when you ask that, increase the dividends.
So you're getting 2 dividends so far.
All right,
so
no,
far.
we will take that down. I think we're aligned. Their shareholders want a return. All right, so there being no further business, where the formal segment of the AGM is adjourned. Thank you.